Hey guys, welcome to Trading Training, the channel that focuses on teaching you how to trade the stock market using Webull. Webull is a great beginner application for trading the stock market because it has no commissions, it has some of the most advanced charting available, and you can download it onto your phone as an app or you can use it on a web-based platform, and these are really accessible options. My name is Catherine, and I'm going to be explaining what each of the different order types are and how they work, how they execute, and how they interact with other orders that other people are placing. If you think there's value in this video, please like and subscribe. Let's get started.
We are going to be talking primarily about 4 order types that you will see on Webull. These are the market order, the limit order, stop order, and stop limit. It's important first to understand how these orders are interacting. So you may or may not be able to see this in your application based on your settings, your subscriptions, but this is essentially what's happening at any given moment in the market. So you have a certain amount of people that are bidding, trying to buy. You have people selling, setting an ask price. This is a pretty extreme example where the numbers are really far apart. If you're dealing with most intraday movement, it might be a few cents, 1 cent. The very inexpensive stocks, it might even be fractions of a cent. But the difference between the highest bid and the lowest ask is called the spread. So sometimes this is larger, sometimes this is smaller. But you should picture these two people, I guess you could say. There's one trying to buy 400 shares at 22.10, and there's another person trying to sell 400 shares at 23.14. It's just a coincidence that it's 400 and 400 in this example. Those quantities could be very different. So what's happening behind the scenes that you're not seeing, and these are just made up numbers just to kind of show you what's happening. Behind the scenes, so starting with that 400 that you can already see on each side, lined up behind those people, okay, so there's a person at the front of each line, the highest bidder and the lowest seller. Lined up behind those people are lower and lower bids on the buy side and higher asks on the sell side. If you have something called level 2, you can actually see these. So behind the scenes, you almost have this line of people queued up that want to buy and a line of people queued up that want to sell. And then you have your bystanders, the people on the sidelines who don't have any orders placed, but they're watching the price movement. Maybe they're thinking about buying in. So it's really important to kind of understand this dynamic to understand how each of the orders really operates. So let's dive in and start first talking about the market order. And I'm going to keep this visual pulled up because it helps to show what we're talking about, and it's a good reminder. So what does the market order do? The market order will always buy at the lowest asking price. So that person at the front of the line who's trying to sell, the market order is going to buy from that person. In reverse, the market order, if you're selling, will sell to the highest bidder. This sounds really good. There's some pros and cons to this. So on the pros side, first, this will execute pretty much immediately. This order is very fast. It's going to just grab whoever the highest bidder or lowest seller is, depending on what you're actually trying to do. There is no need to adjust the price. You're not specifying a price. You're just taking it at the best price that's available in that moment. So it's a little bit faster also to place the order. You're not adjusting the price manually. And I kind of think of market orders as the emergency button. So If I want to try to jump into a stock, and I'm not advocating this, but if I'm trying to jump into a stock very fast, I might place a market order, just as an example. And if I'm trying to get out of a sale really fast or out of a position, then I might use the market order. So this is sort of your, oh no, or oh yeah, and you hit that button as fast as you can. Now there are a couple of cons. You have no control over the price. If you've ever just sat and watched the prices, which hopefully you have, they change very quickly. So you're essentially trying to reach out and grab a speeding train. You don't have any control over the price. And so that's something called slippage, where you might end up buying or selling it for more than you meant to. The other thing is that the market order only executes during market hours. And that's 9:30 a.m. to 4 p.m. Eastern time. If you're not in Eastern, you'll need to convert that for yourself. But a market order is only available during market hours. So you cannot place these in pre-market or extended hours. So let's look at the Webull interface. And I'm using Tesla throughout this example, not necessarily advocating for Tesla. It's just a stock on my watch list. So this is what we're looking at. So let's break down the interface and what you need to fill out in order to place a market order. So first, you would need to specify, are you buying or selling? Once you click that, it's actually interesting. If you look at the bottom where the place order button is, it's blue and it's sort of grayed out. If you decide that you're buying and you click buy, that button will turn green. If you click sell, that button will turn red. It stays grayed out until you have put enough information in to place the order. So are you buying or are you selling? So how many shares? If you have an open position, you don't necessarily have to close that position all at one time. So you can specify how many shares you want. There's a sliding bar available. That's helpful if you have an open position that you're trying to close and you aren't sure if you want to close the whole thing. You can click half or 3/4 pretty easily. You can also type the quantity, and you will need to do that if you are trying to open a position. You want to make sure that the order type says market, and whatever your system is set to default to, whatever order type is in your settings. Let me know in the comments if you'd like to understand a little bit more about those settings and how you can set what your defaults are. You need to check and see what your default is, and you can just check that by opening up an order interface like this one. But if it's not defaulting to market and you want to do a market order, then you need to change that manually. Leave the time in force as day. Nothing else will work for a market order anyway. It's kind of silly that that's there, but that's okay. And then once everything is there, once you have a quantity specified, that button will activate. You can click it and you'll place the order. It will execute immediately. It should basically instantly fill if there's any type of volume behind it at all, which is typically what traders are looking for. So if there's anybody out there that is selling when you're trying to buy or vice versa, it's going to execute. So let's move on to the next order type that we're going to cover, and that is the limit order. Again, I'm just bringing this visual back as a good reference point. So the limit order, we sort of covered already that there are people lined up at ever lower prices to buy and ever higher prices to sell. If you place a limit order, you are getting into this queue. So you are getting in line. If we look at this example, let's say that you're trying to buy shares and you might want to place your bid for $22.05 because you want to get a little bit better price. You're okay to wait, or you think the price will dip down a little bit. You're going to get in line behind every other person who has already placed orders above $22.05. And you'll also be behind anyone who placed an order at $22.05 before you did. So you're very much in line. What can happen with this, I don't have a visual, I apologize, but what can happen with this is you can get in line and the price never gets to you. I've been in trades, or I've been trying to get into trades where the price comes down right above my bid and then it goes back up and it never fills. So that kind of brings us to the pros and cons. The pros to the limit order is you fully control the price that you are going to pay for these shares or the price that you are going to get when you sell these shares. It will execute at that price or it won't execute at all. You can make a strategic entry and exit instead of just, as I said before, reaching out to try to catch the running train. You can wait in that line at a strategic entry point or exit point and wait for the stock price to get to you. The limit order is the order type that executes during extended hours, pre-market and after hours, and during normal market hours. So this order is always available to you. It will always work and function as long as some type of trading hours are happening. So to the cons, you do have a slower entry and exit because you are waiting in that line. So you're not going to jump right in or jump right out as quickly. And as I said before, your order might not execute if the price does not get to you where you are in line. So let's look at a limit order in the Webull interface. So of course, like before, we need to select whether we are buying or selling and the quantity of shares. I'm not going to repeat all of that. We want to make sure it says order type limit. And then this is really the first difference. This is where you will manually input the limit price. How much do you want to pay for your shares or how much do you want to sell them for? This is the price where you will queue up in line and you'll need to adjust this manually. This takes a little bit of time, especially if you've got some adrenaline going and you might be fumbling a little bit. So this is where the limit order is a little bit slower. Now this is different too. Time and force. If you toggle this, you have two options, day or GTC. And GTC stands for good till canceled. And on Webull that means 60 days. So you can actually place a limit order that will stay lingering in the queue for up to 60 days while it waits for your price to be reached. This is helpful if you're not trying to day trade, you're trying to perhaps make an entry on a stock for a longer term investment. You might want to go ahead and do something with a longer time frame. The benefit though is that day will automatically cancel itself at the end of the trading day. In the shorter time frame, a good till canceled order can be helpful if you wanted to possibly try to execute the next morning in pre-market, very early, you might not even be awake yet. GTC is the option you want. It will not cancel overnight. And this is different too. Extended hours allows this order to execute in pre-market or after hours. So remember, the market order can't do that. So this is not an option on that market order. On the limit order, if you want it to execute early in the morning, as I was talking about a moment ago, you would need to select good till canceled and extended hours. If you wanted this to be a long-term order, up to 60 days, you would definitely want to select pre-market or after hours. And then finally, you would place the order. So that is how you operate a limit order in Webull. Now let's get into the more complicated orders. And it's very important that you understand the market order and the limit order going into these next two. So if you feel like you don't have a very good understanding yet, maybe back up, play the video again, go into Webull and give it a try. But you need to really understand those before you can understand these two. So a stop order. We're going to assume that you are long on shares, which means you bought shares, and to close that position, you're going to sell shares. That's the example we're going to use here. A stop order basically says, I want to sell my shares if the trading price drops down to your specified price. whatever that price might be. So this is sort of a safety net for your order. It's also called a stop loss. But the reason I'm calling it a stop order is because that is what it says in Webull. So I don't want to get any, confusion there. But if you look on forums or Facebook groups, or if you're conversing with other traders, they might refer to it as a stop loss. A stop order, and this is the really important part, a stop order converts to a market order when that stop price is triggered. So once the share price drops to whatever your price is that you specify, it converts to a market order, and as we covered before, that means it'll execute at whatever the best price is at that time. Now the thing about stop orders is that they can only operate during market hours as well. So again, 9:30 a.m. to 4 p.m. Eastern Standard Time. This does not work in pre-market or after hours, so you only have that safety net during the actual open market in the middle of the day. A lot of day traders, and I'm not really talking strategy here, but a lot of day traders close their positions before the market closes because they have no safety net. Once they get into those extended trading hours, they have to be actively watching the stock. And a lot can happen in pre-market or after hours. So let's look at how to place that stop order in Webull. It's very similar to what we just looked at, a limit order, but there's just a couple main differences. So are you buying or selling? Again, we're using the example that you are long on shares, so you would be placing a selling stop order. And how many shares? So again, you do not have to place your stop order for the full quantity of shares that you might have. You may only want to place a stop order on half of them, maybe it just as a risk management tool to make sure that if the share price drops down, to a certain point, you've mitigated some of your risk. So that's an option, or you could do all of your shares here. You want to ensure that the order type is set to stop, and then you will input your stop price. So remember, this is not necessarily the price that you will get when these shares sell, but when someone buys or sells shares for this price, your stop will be triggered, it will convert to a market order, and those shares will be gone. It happens very quickly. You can place this as day or good till canceled. It will only operate during market hours, so good till canceled isn't that helpful. I've never used it. And then ultimately you will place the order. So this is how you place a basic stop order in Webull. Again, this is your safety net. If the share price starts to move against you very quickly, it can be helpful to have these in place. The last order type we're covering here is called a stop limit order. And this is a combination of a couple order types we've talked about so far. It's very similar to a stop order, but it has one main difference. So the stop limit order says, I want to sell my shares if the trading price drops to X amount, but the lowest I want to sell them for is, and you're specifying a sale price. So you may already know where this is going. When the stop price is triggered, this order converts to a limit order. Now don't get your hopes up. These still cannot work in extended hours. These are still only working during regular market hours. But it fundamentally converts to a limit order, which you should be familiar with. So let's go over the stop limit order. Are you buying or selling? I know this top part is the same every time and it's probably repetitive, but just in case someone may be fast forwarded through to their order type that they were interested in today, I'm just covering it again. How many shares? And you want to make sure this order type is set to stop limit. If you accidentally set it as stop, then see previous. Now this is where it gets tricky and it can confuse some people. I've answered this question several times on Facebook groups that I'm a part of, and I know why it's confusing. So let me break this down. So as we said before, we're basically saying, I want to sell my shares if the price drops to this stop price. This is the trigger. So when someone buys or sells shares at this price, your order will be triggered and it will convert to a limit order at this price. So this becomes the lowest sale price that you're willing to accept. It's confusing because they called it manual input. So I totally get why people don't understand what the issue is. If this manual input, if you get confused and you make that higher than what you set as the stop price directly above it, Webull will give you an error, and then some people get even more confused. So you're saying, I want to sell these shares if the price drops to $230.76, just using the example on the screen. But I do not want to sell them lower than $229.60. So when this is triggered, it converts to a limit order at $229.60 and it puts you in the queue. If the share prices are still trading above $229.60, then you'll probably get filled pretty quickly. If your order is not filled and the share price drops below $229.60, then you will not get your execution on this order. So it's possible if you place this type of order and you're not paying attention that a trade could turn against you in a pretty big way if your limit order that this turns into doesn't execute and it gets skipped over. So that's something to bear in mind. This is a limit order. So it has the same cons as the limit order we discussed earlier in the video. It might not execute. Again, day or good till canceled, and then you place that order.
I hope this helped explain how all the different order types work, because it's really important that you know what type of order you're placing and how that fits into your overall trading strategy. If you have more questions, or if you'd like to tell me other things you want to learn about the Webull app, please let me know in the comments, and remember to like and subscribe to stay on the lookout for more videos about how to trade the stock market using Webull. Happy trading, and I'll see you next time.